So JP Morgan wants to be your landlord, and so do a lot of Wall Street and hedge fund companies, et cetera, et cetera. Talk about this and more. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy here putting the realism back in real estate. Today is Tuesday, the 16th of May. Hope you're doing well. So yes, very interesting times we see right now, and I guess we'll get into it shortly. One of the things I want to mention, though, is the fact that, if someone once asked me, saying, what was your biggest takeaways from participating pretty heavily in the previous housing, boom, bust, crash, crisis, etc., which is really between 2007 and 8 to about 2012, 13, the peak to trough type of area. My biggest takeaways were, number one, the single family residential home, SFR, is a very desired asset class right now with all sorts of investors. That's number one, and people are going after it, and has caught the attention of all the hedge funds, iBuyers, whatever, big investors, etc. So Wall Street. So that's going on, and also the fact that, well, you know what? The housing market is completely manipulated. Simple as that. It's manipulated by Wall Street, by the government, whatever. So those are my two biggest takeaways. Now, knowing that is important, and then knowing how to work in between the seams of all this is also very important as well, too. So we're going to talk about that. So I think it's interesting. A lot of changes are going on in our marketplace. Hey, this is what I got going on here. Just screenshot this or pause it and take a read. I'm not going to get into it right now, but we participate in all these sub-niches in the foreclosure world. So check it out. Let me know if you want to talk about it. So JP Morgan wants to be your landlord. Now, the interesting thing about this is that this has been going on for quite some time, but now mainstream media is just picking up their interest in, I guess you could say, articles or things that are going on in the industry like this. Maybe it's a slow month for, or it's been dull with all housing affordability issues, whatever. They got to talk about something new. So ultimately, what we have here is that J.P. Morgan, Division of J.P. Morgan, basically purchased this, I guess, community. All right, 172 attached townhomes and 12 detached single-family residential homes on 36 acres. It's located just south of me in Tampa, so it's 46 miles south of Tampa, 14 miles north of Sarasota, in the city of what's called Bradenton. Bradenton is in Manatee County. It's right in between Sarasota and Tampa, St. Petersburg area. Okay, so the neat thing about it, the townhomes, it's a modern Florida rental community. Townhomes renting anywhere between $2,400 and $3,000. So not a bad little setup there if you're looking to rent. So under the surface, there's something that makes it novel. The rental community is owned by J.P. Morgan Asset Management. So earlier this month, Wolfson Development Company sold this development, which was constructed between summer of 2020 and 2023, to J.P. Morgan Asset Management for $59 million. Now, I didn't do the math in my head with respect to how much per unit that costs, but essentially, you got a brand new community, you got low maintenance with brand new homes and townhouses, etc. It makes sense, if they need to put their money someplace and want a good return. This is what's happening right now. So essentially, Blackstone Invitation Homes come to mind here, but Bradenton's purchase is a reminder that the U.S. housing market has the attention of Wall Street's top dog, J.P. Morgan Chase. So this is a clear sign that we're going to see more participation in the real estate community and world with respect to Wall Street banks and whatever. Even before analysts realized that a housing boom would form during the pandemic, J.P. Morgan Asset Management announced that it would, in 2020, it established a $625 million joint venture with American Homes for Rent to build 2,500 single-family rentals across the West and the Southeast. So that's the whole point. They're saying, well, as people age out of their apartments and shared living facilities, they're going to want to live in properties, but they may not have the wherewithal to purchase. So guess what? We're going to finance and create rental communities. Now, America Homes for Rent is is a very large fund as well too. They buy homes and rent them out, fix them, rent them out. We mean my group, back in the last housing crisis, did sell a number of properties that we were short selling to America Homes for Rent. The nice thing about selling them to these hedge funds or these big iBuyers or big investors is the fact that they do pay cash. They'll pay some extra fees. They'll buy more than one. And you don't have to deal with appraisals and loan programs and stuff like that. So it makes the process a lot quicker and easier, and it's a safer bet to sell your property. So essentially, we're going to see more demand in single-family rentals because not everybody wants to rent an apartment these days, right? If you could rent a home, you're doing okay. Now, this is an example of this is just, I guess you could say, where this is located in with respect to. You can't even see above the map cutoff is kind of the lower part of St. Petersburg. So this is really Bradenton, which is south of Tampa Bay. You got Longboat Key, Anna Maria Island, Bradenton Beach, Sarasota, etc. So that's kind of where it's located. So it's a great spot, great location. Basically, it would formed another joint venture. So J.P. Morgan announced another joint venture. They'd allocate $1 billion to purchase single-family rentals across the country in the form of so-called build-to-rent. So basically, these groups, especially J.P. Morgan, but I mean these banks and these large investors are basically making the play. They're going, well, if we can't buy homes either effectively or economically that work for us, then what we're going to do is we're just going to build the communities ourselves. So are they assisting with housing supply? Yes, they're assisting with housing supply, but the housing supply is not being supplied to would-be buyers. It basically is just saying, okay, if you're a younger renter or a renter that maybe is affected by the affordability crisis here with interest rates and low housing inventory, whatever, we'll still give you sort of the quote-unquote the American dream of being in a single-family house, but you're still going to rent it. You won't own it. So think about it. It's smart on their behalf, but you can see that all these new builds that are going on, as much as, when you look, and this is what we don't spike out here. So, and again, I don't know if this is correct or not, but, when every month when the BLS, Bureau of Labor and Statistics, puts out information on single-family homes that are sold, starts, permits, whatever, I don't know whether this stuff like this is included in those pay counts. But really, when it comes down to it, maybe it's great that, we've got 2,000 or 200 new homes starting in the community, but are they actually going to be utilized for end user home sales or in this case for renters? You see, so we're not clear on some of that information. So obviously, basically institutional investors, and this is interesting too, and why we're seeing a change here, because institutional investors who were owning over 1,000 homes based on their profile bought 90% fewer homes in January and February of this year than they did in the first 2 months of 2022. So basically what that says to us is that homes are, number one, too expensive for them to buy, interest rates are too high, and when they look at purchasing, the upside, which would be any form of appreciation, is kind of run out right now. So essentially, Invitation Homes, the largest owner of U.S. single-family rental homes, sold more homes in the first quarter of 2023 than it bought. So 297 units than 194 purchased. So this is not surprising. And I can tell you, if you're a hedge fund or a seriously large investor, it's almost, whenever we see some changes in the marketplace, it's almost like a rule of thumb. What you want to do is look at your bottom 10 performing assets and go, okay, well, can we improve on those assets? If not, maybe we should sell them and cash out now, increase our cash reserves and sell things at the peak. So that's what you see a lot of these guys doing. But it's interesting, again, 90% fewer homes the first 2 months of this year compared to last year. So as I mentioned just a few seconds ago, affordability issues, cost of money issues, what's the resale value down the road, where do they see the market going? So all that plays into the fact that they're buying a heck of a lot less right now. So there's no space immune from capital markets, whether it's multifamily or single family, and everyone has difficulty finding an institutional buyer right now. Institutional home buyers are waiting on the sidelines for either a dip in interest rates or home prices. So again, we all know you can't have high home prices and high interest rates. It just doesn't work. Granted, people who have to move and have to relocate or have to upgrade, downsize, whatever it is, because jobs or family issues need that, they're going to have to do it. But if people have their choice, they're sitting on the sidelines and they're waiting, just like the big funds are here. Even though it's slowed down, it won't go away. The biggest takeaway, that's the biggest takeaway from this purchase of this development in Bradenton. That's also why their build-to-rent arm currently has, and this is the developer, currently has a pipeline of 2,000 housing units in the build-to-rent pipeline with a total exit valuation of nearly $1 billion. So clearly, if you're a developer and you can put together interesting things out there, communities or a number of homes to be purchased in bulk, the institutional buyers will buy. All right, simple as that. They'll help you build a development. They'll help you build a community. And you know what? It's, if you're a developer, builder guy, why not, right? Because you got guaranteed cash buyers. Let them deal with the selling process or the renting process and management after the fact. So again, not a surprise here where the big money goes with respect to what happens in the real estate business. And folks, if you enjoy and like the information I provide on a weekly basis, if you could hit that subscribe button, I'd really appreciate that. And if you are a current subscriber, if you could please resubscribe, hit that bell notification, just because, as I always say, I lose more than I put on. I've been plateauing for the past 2 years now. We know what's going on behind the scenes. All right, so now, since we're talking about foreclosures over the past little while, I've done a couple of videos. We'll do a few more in the rest of the country. So foreclosure activity nationwide shows slight decline in April 2023. So, what I want to basically say here is that this does not mean foreclosures are going away. This does not mean that the housing market is correcting itself and everything is good. Okay, we just saw a small downtick. And to be quite frank, I've been working this market for well over a decade, and I know that there are cycles in the year with foreclosure activity and foreclosure filings. All right, so it doesn't surprise me. I look at things on an annual basis. Yeah, it's nice to see how it plays out monthly and quarterly, but that's why I don't get too bent out of shape either way. So essentially what they're saying here is that foreclosure market report, which shows properties with filings, default notices, scheduled auctions, or bank repossessions, were down 10% from a month ago. So that's basically all activity, but up 8% from a year ago. So keep that in mind. Illinois, Maryland, and New Jersey post the highest foreclosure rates. So that's per capita or number of people per unit. So obviously we've got it looks like we got Illinois number 1 for foreclosure rate, Maryland number 2, Jersey number 3, South Carolina number 4, and Delaware number 5 with respect to foreclosure rates. So that's interesting enough. Metropolitan areas, so Atlantic City, New Jersey, Cleveland, Ohio, Lakeland, Florida, Columbia, South Carolina, Chicago, Illinois was high for cities 200,000 and above. Even though foreclosure activity continues to stabilize and correct itself, with April showing a 10% decrease in overall activity after a 20% increase last month. There's no apparent indication of a continued decline in the number of foreclosures. It is important to note that the month of April typically exhibits a recurring trend of decreased activity. So again, they see it as well too. We have a big March, and then maybe it slows down a little bit, then it picks up. For me, it's 3 to 3.5 cycles of peak foreclosure filing activity. All right. Cities greater than 1 million with a lot of activity for worse rates are Cleveland, Chicago, Riverside, California, Philadelphia, Pennsylvania, and Jacksonville, Florida. That's your worst foreclosure rates. Go a little farther into it here. Foreclosure starts declined 7% from last month. So that's kind of the number I look at. I look at, new foreclosure starts are new filings. So new homeowners are getting a new filing from their lenders, servicing companies saying, hey, you haven't paid your mortgage in a few months. We're now going to initiate the process of starting the process to obtain that asset back. You've got time to cure it. You don't cure it, we're eventually going to take it through the foreclosure auction. So again, it was down 7% from April to March to April, down 7%. It was up 1% from year-over-year statistical analysis. Right. So again, not much growth between March and April, but again, realize that there are cycles in foreclosure filings, basically. States with the greatest increases: Maryland, New Mexico, Iowa, Utah, Florida. That's foreclosure filings. Metro locations with the greatest increases in foreclosure filing starts: New York City, Chicago, Miami, LA, Philadelphia. So of course, we're talking the big cities. Shouldn't come as any surprise here, okay? Should not come as a surprise to anybody that this is going on. So as I mentioned, we're going to have these narratives that are happening now. So now we're talking about these rental communities coming, and being, managed or purchased by banks or Wall Street. Now, as I said, is that a good thing? I don't know. Is it relief for some people as far as accommodation, housing is concerned? Sure it is, but in the end, it's not relief for people who want to buy homes. It's just more rental stuff that's going on there that basically the housing community doesn't really participate in. Okay, simple as that. It's if you don't own it, you can't rent it. You know what I mean? It's the hedge funds own it, or the big players, the banks, the Wall Street people. So it doesn't impact us, and it takes more it takes more inventory off the market that could be potential housing units for sale. So that's what we got going on here. And again, the back end here, we hardly ever talk about foreclosures, or mainstream media hardly ever talks about it. But there's a lot going on, and we're seeing a big increase right now. I'm working on quite a bit of things right now. So touching base here, 10 ways to earn income and build wealth during the housing correction and crisis. Foreclosure auctions, bank-owned, real estate owned by the bank, short sales, short payoffs, taking them over the mortgage subject to the mortgage, okay? Homeowners and condo association foreclosures, they go on here. Tax deed foreclosures, people don't pay their property tax. Probate estate foreclosures, yes, people pass away and stuff sits there and does nothing. Great opportunities. Zombie houses, we know lots of abandoned and disregarded zombie properties all over across the country. That's growing. Underinsured, what I mean by that is, fires, flooding, hurricanes, whatever. Sometimes it stretches in farther than anticipated, and people don't have coverage for insurance. They just get a settlement payout. They can't afford to fix the property. They let it go into foreclosure. Opportunities there. And of course, what we call surplus or overage, that's when somebody buys the property at an auction and the bidding price for the winning bidder is greater than the final judgment or the defaulted price. So there's a surplus there, which the owner is actually entitled to, provided there's no other claims on that. There's ways that we can help them obtain that money and also help ourselves for some income as well. So these are the things that are going on in this world right now that everyone should participate. So if you have any interest in this, please drop me a line, send me an email, give me a shout, a text, call, whatever. I'll talk to you about the programs I have, all right? So once again, thank you for the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe, and we'll look forward to speaking with you later on this week.